Welcome to the podcast. I'm Eric Salzman, joined by Rich Bennett and Kevin Doherty. What's up, boys?
Not
Yeah,
bonds.
Crypto! Crypto's up.
Bitcoin.
We've been waiting. I think we started the podcast right as
The
Wait a
bulls,
minute.
the bulls are back.
hold on. I gotta go.
The
You
bull
know,
hat.
Kevin, so the camera will focus on you.
Yeah, here we go.
Well, he's wearing his bull hat. Yeah, so I think literally when we started this podcast, we pretty much let off the crash, right? I think we kind of came in when crypto was about 100 or 110 or something like that. So
Yeah.
now we're here for the reversal. We're here for
There you go.
anyway. Yeah, we got a
But
lot of
we've
good
been
stuff.
we've been off Broadway. We've been getting shaped up, and now we're coming back onto Broadway.
That's right. So, lots of stuff to talk about. And let's talk first of all about the Secretary of the Treasury, Scott Bessent, his little adventure this week with trying to put his finger in the dike, so to speak. Richie, what do you got?
Yeah. So my daughter works in the bond market. And on Monday, even Monday and Tuesday, when things were selling off, right? She texted me Tuesday night and she's like, wow, it's pretty slow, And I said, yeah, um, the dog days of August. I said, but like Kevin and Eric and I on the podcast talked about it last week, like how August can be like when you're not ready, that's when the stuff happens. So
Yeah,
Wednesday comes out and Bessent goes and buys or says he's going to buy back more 4 billion treasuries instead of 2 billion. So he's basically trying to move interest rates lower with the power of the Fed. So I waited. I'm very good
Treasury.
about leaving her alone. And about 6 p.m. Wednesday, I was like, still quiet? Nope.
So
Nope.
just for some context, and we spoke a lot about this last week, and I think I put it in the Monday morning commentary that we put out, that the 30-year Treasury, the long bond we call it, the week before, it was auctioned. They auctioned the August bond, and it was the highest yield I think in over 20 years
Yeah.
that it actually came out, and the we always call them the bond vigilantes. The bond vigilantes are the guys, and let's tell the Bill Clinton story. So Bill Clinton was coming into office in starting 1993, and they had all these neat spending plans. Where Robert Reich was the Secretary of Labor, and they were going to do all this stuff. And Clinton had Bob Rubin, who I believe had just left Goldman at the time, and back when Goldman was a partnership. So I think he was the co-managing partner.
Yeah.
Um,
It was big.
and Rubin came in and he goes, no, you can't do all this. And the Clinton's like, what are you talking about? He goes, if you do this, the bond market is going to go berserk, going to go hog wild on us, and rates are going to go up dramatically because they're already pissed off about all the spending and the budget deficits, and there's no fiscal discipline. And Clinton had famously said to him, he said, you mean to tell me that my entire program, my reelection, hinges on and he used a stronger word than freaking bond traders. And Bob Urban said, yes, it does. And from that, and he became almost like a conservative, basically a centrist conservative Democrat from that point on. So
Yeah,
that's
and just to interject, I think he's the last one to have a budget surplus, right? He's the
yeah,
last
Mhm.
I
sitting
think so.
president to
I
have a
think we
budget
got
surplus. So he
close
really, he really listened. He didn't want those bond guys being bad. And two, to fast forward, in his first State of the Union address, he has conservative Federal Reserve Chairman Alan Greenspan sitting next to his wife Hillary.
Right.
Like that was like I remember like watching that and like, oh, I probably need to get to the office. Like every bond was purchased the next day. Rates went down like 20%, 20 basis points. It was nuts. People were like, what is that? Who is that? What is he doing? So that Billy C knew how to work the crowd. He was like, yeah,
Yes.
watch, you like this, bond boys? How about this?
Yeah.
Yeah.
Well, yeah, and so those are the bond vigilantes. Basically, investors that have enough power, enough bulk to say, no more. Like we're not showing up at the auction, or we may show up 25% of what we used to show up at, or we're going to start, how about this? We're going to start selling. And that has been absent since the great financial crisis in '08. And as we've talked about, the government, there's no repercussions for running bigger and bigger deficits, because the Fed, they were basically keeping a cap on interest rates with all their quantitative easing programs. And so our folks in Washington never suffered any repercussions, because if you were a bond vigilante and you wanted to sell 1 billion long bonds, our friends at the Fed would buy 20 billion long bonds. Like there was no way you could fight these guys, so they stopped. Well, those days are over. Kevin Warsh is now in charge. We're not doing quantitative easing anymore. And Bessent came out on Wednesday and he announced that he's going to buy back, instead of 2 billion of long dated treasuries, he's going to buy back 4, and he may go even higher. And the market, he did move the markets. The markets all reacted. But everybody, look at one person. I thought it was just a cheap stunt. I think someone's called it a bandaid plugging a bullet hole. But what I wanted to say was, 2 hours later, after he made this announcement, they announced that the debt is, the national debt is now it breached 40 trillion. So can you imagine if that came out without what Bessent did? Like, we'd be at right now, we're at like 5.25 on the long bond, 5.25%. We'd be at 6 right now. Like, it would have been just a total. And I think that's the only reason why he did this. Honestly, they obviously had that news already. And he was like, all right, yeah, I got to do something to at least slow this thing down. So anyway, yeah, so that's the context of this. And this is important because these long dated, like usually the 10-year treasury, the long dated stuff, that really determines roughly what your mortgage rate is going to be. You want to go buy, you want to go buy a car and you want to finance it for 5 years. It's not the long end of the curve, but it certainly gets affected. So the bond market has a lot more to do to affect your everyday life than the stock market. And that's why this is such a big thing.
Yeah. And, being biased, being in the fixed income bond markets, my career, I learned to respect the bond market more than the equity market in terms of what's going on. And I don't know there's a lot of theories around that, why it should be one way or the other more important. But I think it has a lot to do with what you just said, Eric. Like, AI is nice. Apple stock going to all-time highs is nice. But if my mortgage is 7% or 8%, I'm not going to buy that house, and I'm not going to refinance, and I'm not going to go to Home Depot, and I'm not going to go to the furniture store because I'm just staying put, right? And that's a quagmire, right? That really affects everything, right? And someday, some way, that does affect stocks, right? Like, if the earnings all of a sudden slow down because rates are much higher and everything's slowing down in the whole big scheme of things, you better believe equities get hit, and it's happened time and time again.
Right.
You don't know though. That guy, I think his last name is Stork. He used to be at Apollo. He's a big economist. He came out with something today or yesterday that said basically this time it's different because AI is going to make so much more growth, so much more efficient, and we'll be okay with higher interest rates because the economy will still grow. So that's one way to play it.
This is Torsten Slok.
Yeah, that guy.
Yeah, and he put out a chart showing since the Fed started raising rates in 2022,
Right.
the investment in commercial real estate has dropped, as you would expect, because it's rate sensitive. But the investment in data centers has just been going straight up,
Right.
because that is seen as that's a growth play. And if they have to finance these data centers at 5% or 6%, it doesn't matter because they're expecting these enormous AI-based returns.
Yeah, that was his theory. And if we are an AI based economy soon, which it sounds like it's going that way. Great. But,
Yeah.
you know, there's so many other stories behind that that could derail that. And then what? But yeah, so we were talking about it before we came on that so all this stuff that Bessent said and did, we're basically back to right at this moment where the rates were on Monday, you know. So he's, you know, he's piling money into, but nobody's really listening. They listened initially, right? They rates dropped on the 30-year bond, I think 8 or 9 basis points the first day, but now they're backing up again. So is he going to come out Monday and say, I'm going to do 8 billion now instead of 4? Is that going to matter? I don't know.
Nah, like I said, it's a bullet hole over, I mean, a band-aid over a bullet hole. And that's just, you want to, and again, it's not just the profligate spending of the US government, but again, like you mentioned, AI, and we've been talking about this for a while, that, it seems like every month Amazon comes with 20 billion. Meta comes with 15 billion. It's these guys, remember, these were guys that before a year ago, maybe 2 years ago at most, sat on a mountain of cash. They hardly had any debt. Like sometimes you felt like Microsoft would come into the debt markets just to see, like, let's see how much we can raise, just in case we ever need that money. Well, now they are spending billions and billions of dollars on these on AI, and now they're becoming the biggest borrower in the market after the Federal Reserve, I mean, after the Treasury Department. And that is a technical that has not, that just all of a sudden popped up, just like, when Anthropic came out with Claude and all of a sudden it created the software apocalypse, everybody freaked out. It's kind of the same thing, right? And I'm sure debt finance desks on the street love it, but the bottom line is, like, who's going to buy all these bonds? Right? I mean, there's a finite supply of money. There's an infinite amount of supply, it seems, and a finite supply of money to do it. And then we keep talking about Japan. Like they're not the biggest, but they're not the biggest owner of treasuries in the planet. I think the majority is still here in the United States, but they're a huge component of it. And that's because their long dated bonds were trading, capped at 0.5% forever. I think at one point the 10-year was 0.25%. So now that their rates are going close to 3% on the 10-year, they're not doing the trade. Remember, we said they instead of buying their government bonds, they'd buy our government bonds, they'd swap out the currency risk, and that was a great trade and went on forever, went on wash, rinse, repeat for quarters, years, decades. Well, that's done now. That's not going to happen anymore. So are those guys going to not buy treasuries? Sure, they're going to buy treasuries, but they may only buy half what they used to buy. And so the supply is going up and the demand is going down, or the competition is increasing. So again, that is even before we start talking about inflation. And this is all about supply, in my opinion, not inflation.
Yeah. So I think, we've unlocked, some buyers came in, I'm sure. They haven't seen this, like we were saying, the 30 years hasn't been like this since '01. But, there's a lot of people that are old timers like ourselves that would view this just as normal, right? Yeah. Like these are where normal rates were for years. All of a sudden, the great financial crisis happens and everybody's got to be, hooked to 0% rates, right? Right. It's like crack. It's like crack. Like, yeah, I can just borrow for nothing, and this is great. This is awesome.
Oh my God, mortgages are at 6%. The mortgage rates are in the high sixes. That's where they always were before '08, right? So exactly. I mean, but the only problem is that they're at those levels again, but the value of the homes have gone up like 300%. That's the issue. Now, Kevin, you had a great point last week, the week before. You're like, okay, if you buy into this whole AI productivity thing, then that'll be an inflation killer. So maybe a lot of smart guys stops. I'm more than happy to buy and hold the 30-year at 5.5%, whatever, and clip my coupons, because eventually, like you were saying, Kevin, go ahead. Like you were saying about a couple of weeks ago about the productivity.
Yeah, I just said AI is likely to ultimately be deflationary. And
Hmm.
in the short term, it's inflationary because they're building up all these data centers. And so the demand for commodities and everything else is off the charts. But once this stuff gets up and running, that fundamentally AI and more importantly, when robotics really kicks in a few years, that is going to be deflationary because the cost of producing everything is going to fall the more penetration there is of robotics in the economy. So, but it's interesting with the Bessent moves this week. The the interpretation in the cryptocurrency market and specifically the Bitcoin market has been that both of the moves to address the yen and then the moves to address the long bond are that this is all about making sure the financial system doesn't blow up, and that requires more liquidity and basically, call it more cowbell. And so remember the Bitcoin was started in 2009, and the fundamental reason for it is the kind of discussed over the mainstream economic and macro policies, which were about um, government bailouts and banking bailouts that were inherently inflationary. And so this is eroding people's savings, and we need to have a monetary system that's outside of this system that's controlled by the central banks and the governments. And Bitcoin is the solution to that. And the all of the old school Bitcoiners really, this is the core of their belief. This is the core of their narrative why they believe in Bitcoin, because they think it is going to thrive when the rest of the monetary system is inflated or eroded away. So these moves this week by Bessent were just it caused the Bitcoiners to say, "Aha, see, we're right." And it's not about, this is just a small move by Bessent to try and lean on the long end of the bond curve. But it is like, when push comes to shove, this is what they're going to do. This is not the last step by any means. This is just the first steps by Bessent to cave in and accept that when things get rough, they got to step in. They got to provide liquidity to the markets. They got to try and do things to keep the party going. And
Hmm.
so you saw the Bitcoin price exploded on the back of this. Gold was higher as well, and gold is also part of that narrative of
Hmm.
debasement of currency, and you want something that isn't controlled by the central banks. But Bitcoin a week ago when we had the pod, Bitcoin was at 63,000. It basically traded straight up. It's just about $78,000 right now. That's the biggest 1 week move in 3 years in Bitcoin. The last 2 days, there have been, or well, when it really exploded, there were $4 billion of Bitcoin shorts that were liquidated, which is the biggest number ever. The Some other numbers that we look at, and actually, there's a chart we want to look at,
You can
Eric.
show the chart now.
Yeah, bring that onto the
We're
onto
getting
the.
really high tech now.
We are getting high
Oh
tech.
yeah, yeah.
Share.
Share.
Are you seeing the chart?
Yes.
There it is. Yeah.
Excellent.
So for those of you watching along at home, we're not just sound, we're fury as well. So if you can see the chart here, this shows the Bitcoin price is the black squiggly line that starts at on the upper left and goes to the lower right, which normally you don't like to see.
Mhm.
Um, and the green line there is the 200-day moving average, which is a very important
Mm.
technical indicator. And as you can see, in the last rally that we had in Bitcoin in May, the Bitcoin price got up to the 200-day moving average, but then traded back down. And I should back up. So after when the bear market started in Bitcoin in October, the price fell below the 200-day moving average, and has stayed below that level since then until 2 days ago when it blasted through it. and
Hmm.
is a very decisive break of that level. So
Hey, Kevin, just to interrupt you for a second, just for more of a question, but I remember they were talking about back in May when this happened that like the reason why it's such a poor market right now is that when it gets to these levels, guys are
it
selling. They're like,
fails.
oh, yeah, right. Okay, I can
That's
get
right.
out kind of where I bought and get out.
That's right. And
Okay.
what you can also see on this chart, and we've talked about this before, that in one of the classic um, things that happens in a bear market is you get what are called lower highs and lower lows. So what that means is if you can see again on this chart, so in the October highs, Bitcoin was at 126,000, and then it traded down. And it traded, down for a couple, by the beginning of December, it was at what's that, 85,000. And then it recovered a little bit. It spent the next couple months trading a little bit higher, got up to about 95,000, and then traded down again. So that 95,000 was a lower high than the bull market high of 126,000. And then as it traded lower again into February, it got down around 60,000. You see that? That was a lower low because the previous low in November was at 85,000. And so then it rallied again into May, but it never recovered the previous high that it got to in January. So that's what lower highs and lower lows. And as long as that pattern continues, that is a classic bear market pattern. And until that breaks, until you get either a higher low or a higher high, you basically don't want to be confident that you're out of the bear market. And we're very close to that level of being able to set a higher low, and that would be at about $82,200. And so that's something that a lot of people are looking at right now. And if that does happen, they'll take that as confirmation that the bear market is over and we've started into a new bull market. Um, so
Kevin, did
just,
anything happen with was there anything happen with the Clarity Act or something? Wasn't there some
yeah, that was
political?
the other two things. So there was Bessent and his actions this week. Then the big Don, Trump, called a meeting in the White House of the various stakeholders in the cryptocurrency industry and Senate, and he really pushed hard. He said, I want to see the Clarity Act passed. And we've talked about this a lot before. Remember that it's stuck in the Senate. Uh, they haven't brought it to a vote because they don't have the 60 votes needed to pass it. The Senate went on their summer break. They're due to come back in, I don't know exactly when they come back, but supposedly they're going to hold a vote on the Clarity Act on September 15th. And so if that passes, then that could be a catalyst for the market. What's also interesting is the day after that White House meeting, the CFTC chairman came out and said, look, even if we hope that clarity passes on September 15th, but if it doesn't, on the next day, we are going to start implementing the proposals in the Clarity Act and make that the new regulatory structure that we follow. And
Now,
so,
who would argue against that though, Kevin? Like if they said, okay, we're gonna here are the rules of the road. The CFTC is going to do this, and yes, like how can anybody stand up and argue about that?
the politics,
Yeah.
it's politics. And Senator Warren is still virulently opposed to crypto, and she wants to do everything in her power to stop it. We talked about this a couple weeks ago, where the in the last election, opposition to crypto was a vote killer for these congressmen and senators. It doesn't appear to be a vote killer right now, at least on the Democrat side. The polls show that the Democrat voters are mostly opposed to crypto right now. So the senators and the Congress people up for a reelection in these tight districts, they don't feel like they need to be pro crypto at the moment. And
What about
so
what about the new left? Like, wouldn't they be into crypto? Like the new people who are voting for the more, I
they
guess,
should
far
be.
left?
It doesn't seem to be one of their key issues, and they seem to have deferred to uh, Senator Warren, which as did Joe Biden. I think we talked about this before, but the reason that the Democrats were so opposed to crypto uh, is because of Senator Warren. That during the primary in 2020, when Biden was running against Sanders, um, Warren met with Biden and told him that she would break with Sanders and support Biden if she was allowed to appoint the financial the key financial positions. So Secretary of Treasury being a big one, and the SEC. And so she appointed her people into those positions that hated crypto. And so it was a weird little thing. I mean, it's we could talk about this for longer than I think most of our listeners would like. But yeah, it's the crypto people make the case all the time that crypto is actually something that helps the little guy against the banks and other institutions. Unfortunately, you've had stuff like the Trump meme coins and other things that are really, really dodgy that have polluted that message.
Right.
And so, but anyway, the where we are right now is the market has sprung back to life. Um, it's for the last months we haven't talked much about crypto. We've talked about strategy and micro strategy, but that was more about the
Yeah.
financial engineering around it, and not whether crypto is going to, if and when it's going to get out of its bear market. But the kind of the upside of all that is that there hasn't been a lot of attention paid to crypto. Um, and people are generally underinvested from where they were. There isn't much leverage in the market. Some of the big holders of Bitcoin, like the Bitcoin miners, have been selling over the last months. And so, if there is a new bull market that starts, there's a lot of dry tinder out there to to support, the type of exciting market that we kind of grew used to with crypto.
Hopefully they find Toncoin.
Yeah. Yeah, that's well, it's interesting. Bitcoin was hard. Ethereum, which is, as we've talked about, is kind of the number two crypto, second biggest crypto, and it's the smart contract platform. So it shouldn't be as directly sensitive to the Bessent, global liquidity things as Bitcoin is, but it was up even more than Bitcoin. Bitcoin
Mm,
was up 11% yesterday. Ethereum was up 20%. And
nice.
Toncoin swims in the same pool as Ethereum. So
All
it'll
right.
take it's normal. The in a market reversal, from a bear market to a bull market, the blue chips tend to move first, right? And then other stuff gets dragged
Mhm.
along. So,
So let's leave it on a happy note. Everybody look at your statements today. You'll be happy.
yes,
Richie's rubbing his hands.
Yeah. And just a quick aside,
tip your dealer.
um, if anybody got confused on that chart, Kevin explained it well, but it's a lot of, it can be a little tricky if you don't understand those terms all along. They call that technical analysis. I like to use technical analysis with fundamentals. So at a future date, we can have a little technical analysis class on our
Oh,
podcast, which would help everybody. And I can show you some of my secrets that I like to use that are a little different than everybody else's. But
oh,
the bottom line there is just sometimes, like, you can't, nobody, as they like to say, nobody rings the bell when there's a top in the market. You can't really pinpoint um, why, like, if this week Bitcoin moved, there are all those reasons that Kevin explained, but some of it could be tied to. So if you saw that chart at the very bottom right, how it crossed the 200-day moving average, um, Bitcoin, and then it kind of exploded. So that a lot of times they technical chartists, they call them. They don't really care about fundamentals. They care, yes, they want to know, but they look at these charts to say, are we in a favorable pricing graph or are we in an unfavorable pricing graph? And as Kevin said, that this chart is starting to show, and at 82,300 or whatever might be a very key figure, and there might be no news in the markets. Like Bessent might not be buying back more treasuries or anything, and you'll just see the Bitcoin hit that number and then just fly again. And it's like, whoa, what the hell was that? And that's a good thing to understand, even if you're not so sophisticated yet in charts. But that very well could be it. Like it got to a point. So people will always talk about like key numbers, key figures in anything, the S&P 500, the NASDAQ, what have you. And what they're talking about is these charts. When they say key number, watch this number. If it hits there, watch out, it's going to go up. If it hits there, watch out, it's going to go down. So we will.
And obviously, yeah, sorry, just obviously there are no guarantees, but it's all about
it's just
probabilities and risk reward. And
yeah,
these
and
setups,
it's another
more
tool.
favorable risk reward.
Right. It's another tool to use to, help yourself when you invest. And it's always good to have those things. And sometimes, yeah, like Kevin said, like it doesn't work 100% of the time, but it works a lot. And when you blend it with fundamental analysis, what's going on in the world, it can really help. That's where you really get bulled up or bared up, whatever the case.
Speaking of needing help, let's now talk to let's turn our attention to our favorite sports franchise owner, Mr. Mark Walter from Guggenheim. And I know we spoke about this last week about how he basically was playing the Bermuda Triangle, where you buy the insurance company and then blah blah blah, you manage the assets, and somehow that insurance company ends up buying loans that basically lending money to your private equity portfolio companies, and he's having a bit of a problem. And we also talked about how, yes, he had to sell the Lakers, and now they're talking about the Dodgers. Now, one thing that I loved was the great I guess Shohei is a six-tool player because he can pitch and hit and field. He has an opt-out. Did you know this? He has an opt-out in his contract. Now remember, this contract, I think it's about $700 million have been deferred, right? He basically, he's living off his endorsements and his whatever, and he's deferred a lot of money. He did that so the Dodgers can keep him and also bring in one superstar after the next. So I don't know what the escalation is, and he's already said he's not going to do it. But he had an opt-out clause where if Mark Walter was not there, he could opt out of his contract. Now, what that means with regards to how much the Dodgers would have to pay him, because I mean, he can't just go to any other team, right? Because then they would be taking this gigantic liability. So we're all of us who are not Dodger fans, and I'm certainly not, and I don't think Richie is either, ever since that World Series a couple of years ago. Wouldn't it be great, like if they had to come up with, I don't know, $100-200 million right away, and they all of a sudden all these guys they've signed 8 different guys who are getting paid $50 million, a year or more, and now they got to get rid of them? That'd be awesome.
Yeah, well, and also if we're going to put our sports hats on, there's like a really good chance. I tend to follow this. There's a really good chance there's going to be delayed or no baseball in 2027. So that would actually work in Walter's favor, I think, in the sense that if they're not playing, they ain't getting paid, right? So he won't have to write any checks out. But if all these contracts are structured such that he doesn't have to pay right away, it could be bad for Walter because he would just be earning right now and kicking the can down the road and not having to pay. So he'd be cash flow positive, but I don't know how I know Ohtani's the big one with the deferred, but you don't know. And also to throw another wrench in things, Jenny Buss, who was Dr. Jerry Buss, the owner of the Lakers from the 70s, Um, she has stated that she is not approving this sale to the new guys, Bob Iger and Kushner, but her brothers and sisters are, and they're all named Jay, by the way. There's a Joey, there's a Jenny, there's a Gina, there's a Jimmy, so that's kind of cool. But who knows? She's got dough. She's been there a long time. Now she's in a pissing match with her family. If this gets slowed down, right?
These always work out well.
Yeah. She can hire a lawyer, right? She wants to spend money, suing or stopping. I mean, there'll be a judge that'll say, "Yeah, we got a lawsuit here. We got to wait."
Now, kicking the kicking the can down the road theme, get a little more back into finance, was that, we've talked a lot about private credit, and we've talked a lot about how these assets, nobody knows how they're valued. Like, they keep them on the books at par, but then it seems like all of a sudden when something happens, like a default happens, when it finally hits the event of default, all of a sudden it'll go from 100 to zero, like gone. And obviously the asset should have been marked down significantly before that. And that's how these guys make so much money, right? They're earning fees on performance, they're earning fees on that. So people just finally started looking into that as the lawsuits are starting and, investor suits are starting. But it came up very briefly that some of the loans that we were talking about with Walter and his affiliated companies, they wrote down 6.5 billion. So that should tell you what this is all about, right? Like and nobody is really, really digging into this yet, is that these assets ain't worth par, right? They're not worth 100. And the fact that this guy, I mean, it was only like Richie was like, it was like 20 billion, right? It was like something like 20 billion of these. All right. Well, now I'm not saying that the full 6.5 billion are from those 20 billion, but that's a huge freaking write down, right? And so why all of a sudden now have we had to write down? Because people are now probably going through the whole portfolio with a fine tooth comb. If he's borrowed any money from Jamie or anything at JP Morgan, those guys are going through right now, I'm sure, and saying, "Hey, you know what? Get rid of that. We want another loan or pay us back, because that collateral doesn't work anymore." So there's a lot of things going on behind the scenes. And again, will they start looking at the offshore stuff? Because if they start doing that, and then all these guys, Apollo and KKR and Brookfield, they all are in the same game. Like we said last week, the only issue that Walter screwed up was it was like I think we call it the right scam, wrong venue. He didn't move it offshore. Well, now he's kind of screwed it up for everybody, right? And now, will they actually? Will the SEC? Will the Justice? Will they start digging into exactly where all these pension assets have gone, where all this insurance company money has gone, and start looking at what's actually under the hood? That's
two quick points. 2 quick points. We've been stating with megaphones, this is all going down during the all-time highs of the market. This is all happening during the all-time highs. So if these companies are crap that these loans are made to during the all-time highs, what do we think happens when we get a crack in the regular stock market? These things will be kablooey, right? Like, it's gone. Like, if they're down, if he's marking down stuff at 6.5 billion, if tomorrow or Monday, let's say, we had a like an October 87 crash. I'm not saying that's going to happen, but one of those kind of things, those things are all gone. Like, whatever those companies are, you could pick any one of them. They're rated, double B minus, single B, they're gone. Like, when you have a crisis like that in the equity markets, you're worried about like the companies that are really good. Like, are they going to be able to make, their payments on their debt? Second point.
Yeah, I made a mistake here. It's not a $6.5 billion write down. They're taking 6.5 billion out of the life company. So they haven't written them down. As I was going through my head, I'm going, wait, there's no way that they could be down 6.5 billion.
Well, yeah, but he's not taking it out to buy another house.
No.
Right. So somebody might have told him, you don't have to take the write down, but we think your companies that are on your books are worth a lot less than you think. These loans are worth. So,
Yeah.
he might be playing for a rainy day.
Yeah. They're yours now. We'd like something else in their place.
Correct. Correct. The second thing, which always gets my ears up, big article today. Who's coming on now? They've been watching this thing for a long time. The UK pensioners. They're all on board now. They're like, hey, what are you guys doing over there? And the guy from Apollo, the guy from Blackstone, they're all like, yeah, that's the biggest market we have that we haven't tapped into, the UK pension market. So they mentioned like one of the assets that the pension, same idea, right? The Rolls Royce, they mentioned that company. Another big one, British American Tobacco, they farmed out their pension money to the
Okay.
insurer, right?
Pension risk transfers. All right. Yeah.
Right. So what they're going to find, I'm thinking, there aren't a ton of great assets for all that money from Europe, right? So what did they mention?
Data centers.
Data centers. A North Carolina grocery distribution center. So if you're like in London, England, or better yet, the burbs of London, did you know today, Charlie, that your pension just went into some backwoods North Carolina, grocery distribution business? Did you know that? Well, these guys, they just posted that. So are you happy with that, Charlie? Yeah, as long as my check comes, I'm very happy with that.
At least it's not the SPAC deli.
What's that?
I said, at least it's not the SPAC deli. Remember the SPAC deli?
Yeah.
It was like it wasn't even a good sandwich shop in New Jersey. It was like a sandwich shop that was going out of business. And somehow I think Duke or some of the North Carolina universities in Vanderbilt ended up having a couple of million each in that. Well, that's this whole thing though. Remember we talked last week about this whole NVIDIA and then Apollo and KKR and Brookfield all getting together for that nice $500 billion facility so everybody could buy those nice NVIDIA chips. Where do you think all that money's coming from? Right? It's coming from the pension risk transfers and the insurance, and now all the Brits pension risk transfers.
I love the tone. You're reading an article, so you can't tell how the guy's talking, but like the private equity guys, the Apollo, like they were proud, like they were like bragging, like it was basically like, yeah, that was an untapped market, and we got those guys. That's great for us, right? It's like, dude, are you sure? That's good for you, yes. Maybe not the pensioners.
And none other than Lloyd Blankfein, if you remember, Lloyd Blankfein came out last year, right, late last year, and he goes, like it's a great business, and God bless you, but you have great lives already. And if a bunch of institutional investors lose money, no, whatever, you took a risk. But you start screwing around with insurance companies, people's pensions, because you're going to have a big problem if this thing blows up. And he was, again, Lloyd is doing that now that he's retired and, chilling. And he probably would have had to be in this whether he wanted to or not, right?
Yeah.
But, this is what's happening. And again, like we said, I think what was the over under and how many people on the planet actually kind of know what's happening?
Yeah, like 20, 40.
Richie's keeps going down. I think he started at 50 and now he's at 20.
It's so true. It's crazy. Again, at the top of the market, right? This is the top every day, right? Not this week, but like every day the last couple of months.
Well, if the Brits are just getting involved, there's still the German banks and UBS to come in.
They just recovered from 2008.
They need to be last money in at the highest value.
Yeah, I was going to say that's the bell. That's the bell.
Yeah. Do the land banks still exist?
They do.
They do. Well, it's high time they get back involved again. All right, guys, great stuff. I wish we had done we'll leave this with the good thoughts about Bitcoin and crypto. How's that?
Yeah, go.
Here we go.
All right.
82,200. That's the key level. That'll be a higher high, and we'll feel much better about things then. Until then,
We may have a podcast that if it crosses that
emergency. There you go.
82, we're going to have an
Yeah.
interim podcast.
Everybody go out and get a Chicago Bulls hat and get ready to wear it for the special "The Bull Market is Back" podcast.
Get the rally monkey out.
There you go.
All right. Good stuff, guys. Talk next week.
Have a good weekend.
Take care.